This session um, is the most recent. I don't want to say what number. It's the most recent in my risk management series, which is part of a risk management series that Lee also contributed to, and it's all in the pit in one spot under risk management, which I believe is in the business of trading section. Is that correct, JVC?
I believe that is correct. Let me go grab the link.
Okay. So having said that, my previous sessions, I did three other ones, risk management 1, 2, and 3. There's a lot of concepts in those that I'm going to refer to here. So they're kind of prerequisites. You should have watched those. Most people have watched them that are around TRG. If you haven't, some of the things that I'm going to talk about might not make any sense. But I'll try to kind of fill in the gaps on those topics as I go as well. So, I'll try to explain it in a little bit of review of those. So let's do that really quickly. The idea of the risk management series was, a lot of nonsense on Twitter and whatnot. They always, your risk management should be R to R this or R to R that. And as usual, that's an oversimplification and really not the right way to do risk management. Risk management has to be about not losing money, first of all, and then understanding where you're wrong with a trade idea. And that's something you have to have decided before you enter the trade. Where's this idea no longer valid? And that's basic risk management. That's how most discretionary traders do it. And, there's math involved with it too. But that has to be the philosophical basis of not where should I put my fixed stop, but if I'm fading a ledge or if I'm going with a gap and go trend day, where is the thing that I'm trying to take advantage of, the gap and go trend day or fading the ledge? Where is that case no longer true? That's how you have to manage risk. And then you have to build a amount of money or ticks or points around that. And so again, kind of just summarizing through the previous sessions, when the evaluators came along and it became possible to buy a lot of drawdown for very little money, like right now, you can do an eval for $16 and pay a PA fee for, these are 50, so quote unquote $50,000 accounts, $2,500 of drawdown. For basically $180, you can buy the drawdown. You can buy the ability to lose $2,500. And so that kind of changed the game a little bit for a while, and it's still there now. And then again, I'm going to talk more about that as we go. I'm back doing PAs very carefully, just one at a time, just to pull money out of those guys while the legal environment seems to settle down. And again, I'll talk about that a little more further in. But that whole world, that trade that changed the environment of what we could do and how we could take risk, because you could buy money you could lose for less money than how much you could lose. $180 to buy $2,500 of trailing drawdown. That's a really good equation to trade other people's money, assuming you follow the rest of the rules, yada yada yada. Okay, so if you recall, that's when, with the help of a friend who has a fund and has a trading optimization model, some code that his team has developed that every now and then he lets me run my data against. I can't actually use the tool; he does it for me. But that led to the idea of swarming, and that's still a valid idea. Let's talk really quickly again and review what am I talking about with swarming? So I'm going to share my screen real quickly here. And I'm just going to really quickly, again, summarize what was swarming all about and why was I doing it and why did the optimization model suggest that this was a good way to trade. And again, there's two full sessions about this in that group in the library, the link that JVC just posted. Thank you. And so I'm not going to go through all of it, but just here's a quick summary of how this idea worked. If this is a normal profile and that's the mean, and this is SD1 in either direction, SD minus one, and SD2 might be there. So that might be, the value area might be here. And the more extreme we get away from the bell-shaped curve median here, SD3 and 4 even, the more extreme we get away from that. And this middle can be a volume profile, or it could be the VWAP, just some way of measuring statistically an activity. It's going to have a median like that, whether it's the VWAP or it's a bell-shaped curve. The further you get away from that, the more likely mathematically that it's going to go back. So the idea of swarming was really very simple. It was taking advantage of that statistical fact, and that is a statistical fact. So the farther I get away from here, the more likely it is at some point I'm going to head back that way. So if you could scale as it went this way, if you could scale into selling that, or as it went this way, if you could scale into buying that, at some point you would always be right. Now, again, that's a massive oversimplification of swarming. Again, you can go watch the videos, but if you added to the extremeness of it what was happening in the structure and or the price action, you could pretty much find spots that you had 100% chance of making money. And it was just a question of how aggressively you should scale it and where you should start doing that. So that's what swarming was all about. Again, really oversimplified, but that was the basic idea. And by the way, this session is going to be relatively informal. If you have questions or comments, throw them in the chat. I'll get to them along the way. But I really want to be able to make the points I want to make and talk about the newer stuff. But, I need to make sure everyone's coming along with me. Okay. So that was the swarming stuff. And a lot of the evaluation of extremeness would be based on ranges. If you recall, I would have a fast chart and I would have linear regression channels on that chart, and they would measure the best fit of the price action for that interval of time, whatever it was. And again, this was a really good way of gaming swarms, because for a range to break, an established range to break, something has to change. The range is established because we're not, we might go past this every now and then, but we're not exceeding it statistically before we go back this way, or likewise down here before we go back this way. And so the idea of using regression, the math of the best fit, and putting that into evaluations of ranges made total sense. And it was really, really effective for the style of trading that I do. And again, combining that with the 3 types of price action and the context, everything was really straightforward. Okay, so that pretty much gets us to the swarming era, which up until about 2 months ago was what I was doing. And if you recall, also in those sessions, I had 3 levels of swarms that I would do, or 3 levels of risk management for my trades. I would do what I called a 1+1, which is entering with some amount of size, prepared to double that as long as the idea was still valid. And again, the point is that you don't know where the absolute high is going to be, but if the price action says, somewhere up here is the high, then, you're never going to get one entry right. But with a 1+1, you can kind of scale around where you think is right, and it gives you some flexibility. And so that was a simple way of managing the risk of the idea, and then the other 2 ways, which were more extreme, were what I called baby swarms, 5 or 10 micros, scaling in as the trade got more extreme, and then big swarms or giant swarms, which, depending on the size of the account, maybe up to 100 micros or even 150 micros. And again, it's math. This is a mathematical fact. If the market is at an extreme and you keep scaling in against it, sooner or later you will be right. It's just a matter of how much heat you want to take. And that was the problem. A lot of people were practicing swarming and trying to do it, and they were scaling too fast too soon and ended up, just really taking a lot of heat, even if the trade ultimately worked. And so there's a lot of balance to that, and that was the context. And this got us pretty much up to Labor Day. And so that's kind of my quick review of all of those. That's like 6 hours of videos. And, I'm not intending that to be comprehensive if you haven't watched those. To fill in the gaps, you'll need to do that. Okay. So where are we now? Well, what the catalyst for doing this class and for needing a risk management update is two things changed. Number one, we had the legal case against the I don't want to call them prop firms because they're not, the evaluator firm in the Forex space that the CFTC went after. We had that case hit, and as Lee correctly identified, basically what that is now telling us is that the theoretical risk that these guys could blow up and take our money with them, even if we had a lot of profits banked with an evaluator in a PA, that had not happened yet. And now all of a sudden it's happening. But it's only happening to that one company. And so, the first reaction to something like that was a good one. Stop doing that and take a step back and understand how it's changing. And we've had enough time now that we see the CFTC hasn't gone after anybody else right away. The court case on the 16th went down, and they won what they needed to win. The government did, but the case is moving forward. And, they're not going to go after 8 other firms while that one's going on. They're either going to win or lose that one, and then things are going to happen. So, we can probably, again, reasonably assume the bigger firms in that space aren't going to completely blow up, the Apexes, the Top Steps, whatever. But, there's more risk than there was before. And so you have to consider that. And so that was the first thing that changed. The second thing that changed was the market conditions. After Labor Day, we started getting a lot more volatility. The war in the Middle East started. Some other things started happening. China continues to have economic trouble. And, there's all kinds of moving targets that are intersecting in oddball ways in the geopolitical landscape. And so that change in conditions, along with the change in how cheaply we can buy drawdown, made for a completely different environment. And one of the things that is fun to talk about with respect to this, I've been trading for 51 years now, and whenever there's a change in conditions that causes me to go back and question my assumptions and revisit my playbook, and this was such a case, it doesn't happen that often, but when it does, it's really obvious because nothing works. Things just stop working. Everything that worked for the 3 years before that isn't working now. And, and it's not working by a lot. It's just, it seems like something's off all the time. And that's a really good kind of red flag that, guess what? Conditions have changed and you really need to take a break and pay attention to that. So what I did is something that I do whenever that red flag goes off. And I've been asked, and it's a great question, how often does this happen? Well, in my 51 years of trading, I can think of somewhere around 10 to maybe 16 times that conditions changed radically. And so, the short answer is it doesn't happen very often, a couple of times a decade. So like the last big shift we had was 2008. And then most of the, 2010 to 2020 up until COVID was a pretty strong trending move for the market. And then COVID hit and everything changed. But it changed, kind of within the framework of what had been happening. And what's changed now is that's not true anymore. The market, and this is what I mean by this, and this is a really important point. So let me draw again really quickly here, get a different color. So what was happening before, and this is why I was using regression in ranges, the market would establish an ebb and flow range, whether it was on a very fast chart or it was on a TPO view or a daily view of a period of weeks. Ebb and flow behavior is really easy to understand that, okay, the market has found that this is the value for now. And if we get too far away from what it considers value, we go back the other way. And, that's typical when the market's well behaved and everyone agrees on what's going on. That's what we see, no matter what the time frame is. Again, it doesn't matter if it's a 1 second chart or a daily chart. That's ebb and flow, and the market pretty much agrees. So when you have those kinds of conditions, it's fairly easy to look at the range, whether, again, it's a LRC of a fast view or it's the initial balance, look at it and say, okay, that's a well-defined range. I can trade that range. Well, one of the things that changed was instead of seeing this kind of behavior, we started seeing this kind of behavior where the market would do that for a little while and then we'd get this. And then, not always for any apparent reason. And then everyone would jump in and start selling into it, and then we'd get this. And, then it might go into ebb and flow up there for an hour, and then it might come right back to here. And so instead of the range being respected, the range was getting broken really aggressively in both directions. And often, again, for no apparent reason. And what is this? This is price discovery. And if you look at the TPO views from a little while ago, it's really easy to see when all that started changing. We were pretty predictable back in here. We go into a little apex, we trade away from it, we trade back up to that range. But since a couple of weeks ago, again, right around Labor Day, we started to go into these massive moves. And the only other time we had massive intraday moves was around economic releases. And you can see we had them, but they were, a week or two or three apart. And then we started getting, there's one there, there's one there, there's one there, there's one there. We started getting them almost every day. And they weren't always in the same direction. The market would sell off, but then we'd have a short squeeze day. And, here we are in a little baby ebb and flow. And then boom, we short squeeze right back up to the previous little range. So it's the same kind of ranging behavior, but it was stretching way out. It wasn't respecting these tight little price ranges, whether again you're looking at a very, very fast chart of seconds, or you're looking at TPOs, or you're looking at the daily. The conditions changed, and it was obvious that they did that. Here's the daily, and again the exact same thing happened. We were in this really predictable, we were revisiting the highs. We weren't pulling away real high. When we'd get away from that area, we'd trade back to it. And then ever since then, we've just been putting in like single time framing in one direction. We hadn't seen that in a long time. And we're seeing it again where, it time frames down for a week every day. And so when stuff like that happens, I've kind of taught myself that the right response is to, first of all, take a break. So the first thing I did when Lee did his session on, the legal ramifications and whatnot, I said, you know what, this is important. I need to think about this. So I was cat sitting at the time. So I went over to Trader Cat's house and just for like 3 days, I didn't trade at all. And other than the classes I was doing, if I had them, I didn't even look at the market. I just took a break and I said, okay. And then when I was done with the break, I said, all right, I need to go back to what I do. And again, what I do is really simple. I trade price action, and price action comes in one of three forms. And again, this is fact. It's not like this is Jeff's opinion. The market's either going one way, that's what I call high momentum, or it's going both ways really aggressively. That's price discovery. We see that around news releases, for example, or earnings releases. The market just goes crazy because it doesn't know how to value itself. And then the third one is ebb and flow. And that's when the market more or less agrees on value. And so I looked at that and I said, okay, so what's changing? And the answer was really obvious. Well, ebb and flows aren't holding ranges. It tries to get in a range and then, whoa, hold on, we go 200 points out of the range. And then, hold on, we didn't like that. Let's turn around and let's go 200 points back into the range that we just went out of the range. And just for fun, let's go another 100 points further. And that was happening almost on a daily basis. And again, the thing that always triggers me to, okay, you need to go back and reassess is when that happens, when there's just a thing jumping in my face saying, hey, this is different. Okay, so how did I react to that? Well, again, the first thing is take a break. The second thing is, okay, what's different? And the conclusion as to what was different was very simple. Ranges were not being respected. So the whole idea of trading ranges and gaming them with LRCs became less important. And I just, kind of from my point of view, it was kind of a natural, well, let's do it a different way. And here's the way. It's real simple. These are LRs on this chart. This is a 1 second view. And I went in very quickly, again, even faster than the old 5 second or 15 seconds, because all I'm trying to assess here is the price action and the volume around it. And that's what the wave volumes are. So instead of using regression channels I switched to just the same idea, regression, which is the best fit, but I don't want to see two standard deviations in either way, in either direction. I just want to see the mean. So this is a linear regression. And it's not the channel, it's just the regression. It's the middle line, the median. And I'm using two different settings. There's only two of them. And I'm using the same thing. I've standardized on this now. The R&D period that I went into after I started working on it after the break, that went on for 3 weeks. And I tested a few different iterations of this idea. And I settled on this one. So I'm still looking at wave volume. That's what the volume in green or red is. And then what I'm doing on this 1 second chart, I'm either doing 60 or 300 bars. So that first regression is a minute. You can see as it's rolling over, see how it turns. It's really responsive to the price action. So right now, from that short-term direction versus short-term trend that I keep mentioning, that's the new way of measuring the very short-term regression. Right now, we are ebb and flow at the top of this move up. So the 5-minute slope is up. So we moved up very clearly from here, but we've stopped doing that now. So if you were long, you want to have taken profits, and it could be a short, but we don't know enough just looking at this. And the only thing that I change with this is sometimes I will go to 2 seconds instead of 1 second. And that will give me 2 minutes and 10 minutes. And I'll switch it to that. And you can see what it does is the same thing. It's the middle of the movement, but I'm just going back slightly farther. Let me see what's the slope of 2 minutes versus the slope of 10, or the slope of 1 minute versus 5. And again, it's just the geometry of the best fit. It's the exact same thing I was looking for with regression channels, but the idea of the channel isn't valid under these conditions. The idea of using the mean in the middle, the median actually, is not only mathematically valid, but it suits the conditions. And you can see it's really responsive to the price action. Like right here, it shows exactly where we stopped going up. And right here, we're balanced. So again, this is if I just go out to 2 seconds. And so this is still the same interval. And so we're looking at 2 minutes and 10 minutes. And again, it paints a really clear picture of what the price action's doing. I can't miss it. I'm sorry, I'm trying to stretch this out so it's easier to see. You can't miss what's happening right now, and that's the purpose of that. Okay, let's see, I have a question. It seems that by utilizing the LRC for the price action, when in R&D, you're able to really get back in tune with the conditions. Well, that the channel or the regression, I'm not sure what you're asking me there, David. Can you rephrase that? Anyway, let me continue. So again, that was the first thing that I did. I said, okay, I still like the idea of understanding the short-term direction and the short-term range, but I want to see the middle of it, not the extremes of it, or not two standard deviations of it. And then secondarily, what I'm going to start being concerned with is the slope of it. So the slope of the faster one versus the slope of the slower one. And again, if we leave this on 1 second, you can watch those as I'm talking. It's very, very responsive to the short-term price action. And therefore, it's really useful for all of the setups I'm going to talk about, but particularly number 4, which is the hardest one to do. And so this is the most powerful. This tool is the most useful and the most powerful for setup number 4, which is what I'm calling STD, STT, short-term direction, short-term trend. And again, we'll come back to each of these, but I'm just kind of introducing. So let's see. Jeff, how am I interpreting the fast as it turns and indicates? I'll get to that. I'm going to, the way to interpret it is in the context of the 4 setups, Alfredo. And so I'll give you lots of examples of that. What I'm trying to do in the first 30 minutes or so here is completely cover what I'm doing, how I'm doing it, and what's different. And then the execution of it will come after that, and we'll go as deep into the execution as we have time for. But if you guys don't understand the theory, the execution won't matter. You always want to stay focused on that. Okay, David, I see your comment. Okay, so you can see it repainted the 1 second. And so again, 60 bars of 1 second, in other words, a minute, or 300 bars, 5 minutes. Okay, so that served 2 purposes. It helped me evaluate the first thing. So when I started looking at the change of conditions, the first thing I noticed was, as I said, ranges weren't being respected. We would form a range and then immediately break it, and not just by 2 standard deviations, but we'd break it by 6 standard deviations, and then 2 minutes later we'd be right back in the middle of that range. And so the whole idea of measuring the range on a very fast interval didn't make sense anymore. And if you remember, a couple of weeks ago, one of the things I was doing in R&D was I was using the LRCs over slightly longer periods, and I was measuring for a while. That was the first week. So if that's what you're asking me about, David, now I understand your question, I think. So I was adjusting the LRCs to try to figure out if there was a range that was capturable, and the point was there wasn't. So I said, all right, I don't want to use the range, I want to use the median. Okay, that was conclusion number one, and that was a really good one. At some point, ranges might become predictable again, but in the meantime, the slopes of the regressions, not the regression channels, are very, very telling. And particularly for these 4 setups, and when we talk about execution, I'll explain how. Okay, so that was the first revelation. The second revelation that I had was that the risk management approach that I was taking up until that point with 1+1s, baby swarms, and giant swarms was, again, because the momentum often went off on its own forever, that if you have enough size, you can scale into a move counter trend and be right ultimately. But I was taking way too much heat doing that. So I said, okay, for now, swarms need to go away, and I need to really focus on measuring the momentum and how I can either join the momentum or fade it, and where to do that. So that led to setup number one. When you have this much momentum frequently, like, just look at the open today. Here, let's just look at ES for a reference point. Here's the open right here. That's the opening 15 minutes in the yellow bracket, and that's one of the other setups. We'll get to that one in a minute. That's the opening 15-minute range, but it really just moved around in a fairly tight range. This is 7 points here. But boy, once we get momentum and we get moving, like earlier in the morning, we had this happen. Look what happens. It will go from not really going anywhere to just in a heartbeat. We went from 18 all the way to 28, 10 points in ES, and it's doing that a lot. And then we established the initial balance, and then guess what? We came back 14 points right back into the middle of the range. And I was seeing this over and over again. I said, okay, there's got to be a way to capture the momentum and deal with that just as a setup. So the first thing that I did with respect to that was the thing we've already talked about. Switch to regression, and the slope of the regression tells me the nature of the momentum, and we'll come back to that. The second thing that I did was I started, I've always had my bars painted, and what's painting the bars on my chart is an indicator called TS Supertrend, and it's using basically just the idea of an ATR trailing stop. And that's how it's deciding if it's blue uptrend or pink downtrend. And then I just added one other thing to it. This line that's changing color is just representing which condition is it in right now. So if it's in quote unquote downtrend, then where that changes is what that's doing. So it's just an ATR stop that's following the price up or down. And then you'll see we just touched it. So now it flipped back over to being long. So again, I'm not using that as a trading signal, but I wanted some way of having a line in the sand for where the trend was in the very, very short term, either going up or down. So I put that, I put that on both my 1 second view, and I put it on my 60-second to 120-second view. And this is the one I also put on the standard deviations of the VWAP. That's what the red line and the yellow line and the tan or orange line are here. Those are the what we always talk about. The VWAP isn't on here because it just makes another line in the middle, but this is SD1 and this is SD2 and that's SD3 and that's SD4 and the same going the other way. So this was a way of looking at where is the initial balance, where's the 15-minute range, and where is it with respect to extremes. Like that set up a really nice retracement long right there this morning. And again, once we broke out of that 15-minute range, that was a long, and then it pulled back right to it, and that was another long. So I'm jumping ahead into the execution of one of the other setups, which is the 15-minute break. So again, just to be clear, there's 4 new setups. Number 1 is momentum, either joining it or fading it, and measuring momentum properly was key to that. So that's number 1. Number 2 is the 15-minute break, which I have on my charts as the yellow lines. And I've said this in every live session for weeks. That, particularly if there's a gap in the same direction, the odds of that trade working are 100%, meaning I have not found examples where that doesn't work. So here's today, and we gapped up in NQ and ES, and then all you had to do was go with the 15-minute break in the same direction. And that was right there in NQ at 69. And NQ went all the way to 49. So it went almost 100 points. ES went from the 15-minute break was right there. And that was, call it 18 to 20, depending on how fast you caught it. And it rode all the way up from, 20 to 48. And again, it faded at the SD2 extreme after it spent some time up there. And this was the trade I was talking about earlier, where, I just knew that on FOMC day, we're not going to have a trend day. So I knew this gap and go trend wasn't going to continue. But the question was, where was it going to stop? And you had to be considering the momentum for that. So that is setup number 2. And setup number 3 is the intraday swing. And that's what I talked about when I was talking about swarming a couple of minutes ago and introducing the idea of there's some extreme where you can play the other way because it's just so asymmetric that, it's such a good idea. But the problem with that, with swarming and just getting more aggressive as it got more extreme, was that we've had a couple of days where it got really extreme and then turned. There was a day, not this week, not last week, but the week before, where we got almost 3% up in the indexes, which is a really strong trend move. And then we got to minus 1% the other way. And then the day ended up closing between 1% up and 1% down. So more or less in the middle again. And those are really, normally a day when we're up 3% will be a trend day all day. But that's what's different. And so I started seeing that and saying, you know what? I need a setup that takes advantage of that. And the only way I could come up with to manage risk if I was doing that was to not consider the price at all, because the prices aren't making any sense when it's doing that. So the only way I could do it is I could say, okay, at this really asymmetric extreme, whatever it was, whatever way I was measuring that, the ATR or the SD4 or, the wave volume, whatever. Pick a way. I would look at that and say, okay, forget the prices. Can I put a micro trade on here with 1 or 2 or 3 or 4 micros and have some line in the sand where I'm wrong just based on dollars? So can I look at, is this idea worth risking $50 on for 2 micros? And where would that be? And so I started doing that with intraday swings, and I started finding that was really good. Regardless of what the other 3 setups were doing, that was a productive way to trade this. But you could sit around all day waiting for that to happen once, if it even happened at all. And so the other setups happen much more routinely. Momentum we're getting a lot of all day, and we're getting the 15-minute break every day, and we often revisit it like I just showed you, and you get another bite at that apple. So that's proving to be a really good trade to take in the first 2 hours. At the open, and then, retracements to it. And then this time of the day, I start looking for other things to do, like 3-tick scalps in ES. And where can I do those? Well, I don't want to do those when there's high momentum unless I can go with it. Ledge is breaking in ES. Okay, I can take 3 ticks with the ledge break. That'll work. But I'm not really doing a 3-tick trade there. I'm really just joining momentum. And the 15-minute break trade, I want to give it more room. I really don't want to scalp for ticks. The intraday swing, I want to use micros and look for lots of points. So again, that's not that. So I started thinking again, okay, when we're near inflection points, which this happens a lot, like up here when we established the initial balance high today, this was a really target-rich environment to just look for a couple of ticks at a time, because it was trading really predictably when that was happening, and there was good size on both sides of the market. So it was pretty obvious we were going to just go back and forth there for a while, and that looked like this. we got up there on high momentum. So that's a high momentum trade. Okay. And you pretty much wanted to be long or nothing on that. And that worked out really well. The 15-minute break long was a gorgeous trade. Okay. Then we went into this little ebb and flow up here. And we really, once we put in the initial balance, we really just kind of traded around it. We'd go up a couple of points, we'd come back really aggressively. So once I saw that happening, I said, okay, this is the kind of environment where I can probably go for 3 ticks at a time. And that's in ES. And so I started, what am I looking for there? And on the 62nd, I really can't see it. I can see that it's a good place to do that. But what I was looking for there was the following. I started to see, okay, at certain inflection points, there's a set of conditions where the relationship between the short-term trend, which is what I'm calling the 5-minute, this one, and the short-term direction, which is this other one right here. So, for example, if we're coming up really strongly in the 5-minute trend, but the short-term one has gone from being parallel with it, which means we're strongly trending, to being flat, that's a really good spot to scalp 3 ticks at a time in ES when that condition was happening. And so I named that setup, that's my 4th setup, that's the STD versus the STT. And it's the thing you can do almost any time of the day whenever those conditions occur. And like they're occurring right now over here in NQ. So, and you can see that just turned green, indicating you could probably scalp that for a couple of ticks to the long side. And so that's what I'm looking for there. But you can see it on the, hang on, I need to erase here. Oh, what happened? I can't erase. There we go. Okay. So what you're looking for when you're doing that is you want to look for that behavior, but you want to watch it on the 1-second chart. So that exact same scenario that I was just showing you in ES when it was up at its initial balance high, let's go look at the fast 1-second view when it was up there, and let's see what that looked like. And you'll see, you can imagine if you look at it, what the fast and the short-term trend and the short-term direction would look like. Up here, they both would have been sloped up. But then up in here, that's where the fast one would have started turning. And you could have scalped short or long repeatedly up here. I was doing it short, and 3 ticks at a time in ES is $37.50. Pay the commission, it's $4. That's still a nice $30 plus trade over and over again. And so I do that there, but only when it's predictable. And you can also do the short-term trends, short-term direction trade in NQ. And what I'm doing over there is I'm doing blocks of 2 micros, and I'm scaling in and out of it. So the same idea, when I'm seeing, potential change in direction, I'll start nibbling in. And so it's kind of like a little baby swarm. And that led to a new form of swarming. And this is the last theoretical thing I'm going to explain, and then we'll talk about the setups and the risk management. That led me to understanding that there were conditions in NQ and MNQ where a new form of swarm made sense, where I was getting a really asymmetric opportunity, and where that short-term direction versus the short-term trend was also happening in my favor. That was a good spot to put on 2 micros at a time of particularly MNQ. It works better there because of the elastic behavior of NQ. But the same idea could be done in MES. And so that's how I rounded out the playbook. There's 4 setups. There's momentum, which I'm generally trying to trade in MNQ or NQ, and sometimes, if the conditions are really optimal, maybe in ES. Then there's the 15-minute break, which you can trade in either one of them. And that's ideal if it's a gap and go in the same direction as the 15-minute break. And then the third one is the intraday swing, which I'm only doing in MES because that's the productive place to do it. And I'm doing it with, 2 at a time of MES up to, maybe 10 of them, but preferably less. It seems to work really well if you put the trade on at the right spot with good odds. With about 4 of them, that gives you a nice little risk reward, and you can have okay, I'm wrong for $50 here with that kind of size, and it's tradable in ES. Whereas I can't do that in NQ. It moves around too much to do that. So what I'm doing over there, if I have an extreme, is I'm just looking at the STD, STT, and scalping around that. And every now and then I'm getting lucky and catching really big runners in MNQ doing the STD, STT trade as if it were an intraday swing. And so, kind of put on a couple, try to get a couple off right away, protect the profit, and then every now and then it does that flush the toilet that NQ does, and it just drops 20 points in my favor, or it goes up 20 points in my favor, and I'm still in it for a couple of contracts. That's happened a few times for, multi-$100 winners with 2 micros in MNQ. That's happened in the last 2 weeks now, 3-4 times. And it's really cool when that happens, because again, the risk is so low because of the way we're executing against it. Okay, need to take a sip of water there. I'm going to pause for a minute here, and those are the 4 setups, and that's the thinking around them. If I have to do a follow-up session to this, I will. But the tactics and the instrumentation for each setup are different. So again, 4 setups: momentum, 15-minute break, intraday swing, and STD, STT. The momentum trade is primarily in NQ or MNQ because you can just make so much more money with it over there. But that doesn't mean I wouldn't do it in MES. Wouldn't do anything in ES except the 3-tick scalp right now, because there's no way to manage any size risk in ES for me in these setups. So again, momentum preferably in MNQ. 15-minute break works great in ES. Works great in MES, works great in NQ, works great in MNQ, just depending on how much risk and size you want to play. If we have a gap in the same direction of the 15-minute breaks, I have not found an instance of that where that trade did not work, like today. And if it isn't a gap and go in that direction, the 15-minute break is still working about 86%, 87% of the time. So that's that one. And then again, number 3, intraday swing, primarily doing that in MES because the tick value is better than MNQ. But sometimes if the STD, STT conditions say, yeah, you could kind of start that in MNQ, then I'm starting in MNQ, and sometimes I'm catching big giant winners. And of course, that's the last item in the playbook, is just playing the very short-term direction as described by the slope of the 1 second, 1 minute view. So right now, the short-term direction is up. See it? You can't miss it. It's up. And that's why we're blue and green here. The green is just summarizing the blue for me with a trailing stop. So this is short-term direction up. This is a long trade. Okay. And then again, if you caught it as that was turning, you caught the bottom of a high momentum move down that could end up being a high momentum move up all the way back up here. But at least, it's a good spot to play the reversal. And so that's what I'm doing with it. And then the 5-minute one is telling me what's the short-term trend. So short-term direction, short-term trend, 1 second chart using either 1 or 2 seconds. So it's either 1 minute to 5 minutes or 2 minutes to 10 minutes. Okay, let's see. And the bar setting again, please, on the 1 second and 1 minute for the, okay, if it's a 1 second bar, then it's 60 seconds, right? So there's 60 and 300. And so that gives you 1 minute on a 1 second and 5 minutes on a 1 second. And then on a 2 second, it gives you 2 minutes and 10 minutes. Got it? So the settings are 60 and 300. And then again, this is the middle. It's the median of the regression, not the channel. So if you're in something like NinjaTrader, it's still a regression channel, but what I'm doing is I'm just plotting the middle, and I've got the edges of it transparent. And then so that all that matters is the period. The number of standard deviations don't matter because I'm not looking at the width of it. I'm just looking at where the middle is, which is the median. That's what we want. Okay. So, and again, I may not have time to talk about all the different tactics for how to execute against these 4 setups, but I'm going to give this an hour till the top of the hour here, about another 15 minutes. And I just, if we get through all the theory and just the 4 different playbook items and the thinking behind them and why they match the current conditions, then we'll achieve my objective. And then again, if I need to do a follow-up or a Q&A on it later on, I can. Okay, let's see. Bar says, how do those lines on 1 or 2 second fast charts help to know where you are wrong? They're not. Remember, on STD, STT, I don't care where I'm wrong. All I'm looking at is the relationship between the short-term direction and the short-term trend. Remember, the whole idea of thinking in terms of where am I wrong isn't in this playbook. This playbook is either joining or fading momentum. And if we're doing that in swings, in the intraday swings, we're going to just assign a dollar value of risk to it. Otherwise, if I'm scalping STD, STT in NQ, I'm going to protect it in tick and be looking for points. And I'm not going to try to do that in ES, except when I'm doing 3 tick drills around really clear inflection points. And so it's different for each instrument, for each setup. But there aren't canned rules for it like that. Does that make sense, Bar? These are great questions, by the way. Keep them coming. And what other questions are there? Again, we'll keep going, and I'll talk about the setups and the risk management a little bit more. But this is all new material to you guys, so a lot of the risk management stuff won't make sense until you've thought about it a little while too. So the idea is, if we have momentum and it's setup number one, if we have momentum and it's joinable, join it. That end of conversation, because this momentum is going on, and there is no where am I right, where am I wrong bar. It's like, I'm going to join the momentum until it stops being momentum. And that's what the regression on the very fast 1 second are telling me. Like right now, we're trend direction up. We're direction up and trend up, but there isn't a whole lot of momentum. We're barely making higher highs compared to what it was doing at the open, where it was just ripping to higher highs, particularly once it broke the 15-minute range. So what's happening right now is nothing like the energy of the momentum to the upside. And that's also why I'm putting the bar by bar delta on the bottom, because you can see when it wanes, it stops trading heavily into the ask and we start trading into the bid, and then we go back toward the downside and vice versa. So it's really telegraphing the energy of the direction and the energy of that short-term trend. And that's why I'm measuring it that way. The settings for my trailing stop, the super trend, let me show you that if you guys want to try to duplicate that. I know there's been some work on that in Sierra Chart already, but it's a free indicator that's out there called TS Super Trend. And then I'm using an ATR. It's an ATR using a Hall moving average, and then it's a 14-period ATR with a 2.6 multiplier, and then a 10-period Hall moving average to smooth out that ATR. That's what my settings are, and I never change those. And again, I just look at this as it's not necessarily where am I wrong, but it shows me statistically where the trend is changing. Like right now on the 60-second, it's a downtrend, but on the 1 second, it's an uptrend. And that's why this one's red and that one's, you see how that one just turned red again. So it's kind of back and forth up here. And it would switch that over when it's like a stop and reverse. If you know the stop and reverse indicator, it can't touch it. If it touches it, it automatically reverses. So it has to be either in long or short mode, and it trails, but it never goes back the other way. It only trails. So now it will hold here until we touch it. And then if we touch it, it will turn green. And that's the nature of a stop and reversed ATR stop. And what I'm doing is I'm using that as just a real short-term way of gaming the trend. That's what I'm doing. Okay, so I still see there's some Sierra Chart conversation going on. That's fine. All right, so are there any other questions about any of the logic of this? And does everybody understand why I did what I did and how it's helpful? Or let me rephrase that. Does anybody not understand, the logic behind the change, why those 4 items in those 4 setups in the playbook make sense for these conditions and why I did what I did? Does anybody not get that? I'd be happy to spend more time explaining it. Otherwise, that's probably a good place to start wrapping up. And then I could now in my live sessions, I can talk about it and you all will have at least seen this and it will make more sense. For example, one of the things we're doing now that it's November, I'm not doing care and feeding of inflection points anymore on Tuesdays. I'm going to do trading the open on Tuesdays again, and starting next Tuesday. And so you'll get to see this, right at the open real time. And that'll be a good chance to see, for example, the 15-minute break and to see the interaction of the STD, STT, and, the intraday swings if we get them. So. All right, I'm starting to lose my voice again, which is a problem I've had for this week. So I'm gonna talk less and just pause here for a few minutes and see if any other questions come up, and you guys can think about it for a minute. I'm gonna refill my water one more time. And so if you have any other questions or comments, put them in the chat. Otherwise, we'll wrap up in a couple of minutes. Again, I hope everybody understands, how I got to where I got and why. And again, just to summarize the risk management part, I didn't go into a lot of detail about that, but I'm not really doing 1+1s anymore because that doesn't really make sense. And the different setups, like joining momentum, I will scale into a winner as aggressively as I can. And then in that very same situation where I then see a high volume reversal, I might scale into fading it like I would have done with a swarm in the past. I'm doing both of those things. I'm doing with momentum, I'm doing a lot of trading around a core position. Like in that move up, I was trading around a core long and scaling in and out. So I kept taking profit. And then once we put in that ebb and flow at the initial balance high, that's when I started looking for shorts and I started scaling into a short. And so, and you can do that with any of the setups, really. Okay, let's see. Let me read the questions here. So basically, the short starts to turn after down. That momentum will be nice. Yeah. And again, you got to watch this for a while to get a sense of how it works. And I will share, if you have the lifetime version of Ninja, everything will carry over as you see it. If you don't, all of this stuff is available except that bar by bar delta. That's in the lifetime version, and TS Supertrend is a free indicator. It's already shared in the pit. I'll share this workspace, but I'm not going to do a lot of technical support for NinjaTrader. If you have it, you're going to have to figure it out on your own. But it basically, that's the only thing that you would need the lifetime version for, is the bar by bar delta, and you can get a third-party version of that. In fact, while we're waiting to see if anybody's going to ask other questions, let me do that right now. So hang on. Okay, this is my NinjaTrader one. And that's all you guys will need. So let's see. Templates. Current Jigsaw, no. Footprint, NinjaTrader 8. Okay. Current NT8 with new LRs for 4 new playbook setups. Okay. And there's that one right there. Okay. All right. So that's there if you guys want to play with it. Let's see. Risk management works or it doesn't on the first. The tosses you have to do by grid, David, and they're already shared. The current tosses are shared. And if you look in that same part of the pit, you have to do those by grid. And I guess you refer to the daily and toss for the full 1 or 2 years. Yeah, that's the only place I zoom out that much at all, is on that daily view. I don't zoom out that far on anything else. But the Thinkorswim template is already in the pit. It's in the same place under templates. In fact, I just updated it. Yeah, I just updated it recently in August. It hasn't changed since then. You can see right there. They're all right here, David. Okay, are there any other questions about anything? I think I got all those. And again, it might make sense to do a follow-up session on some of this stuff after you guys have had a chance to see it. But I will talk to it now in all my live sessions. So, for example, Friday I'm doing the trading the close, and obviously I'll do it with these tools, and I will explain them as I'm doing them, as I usually do, and put my domes back up here and put that in there. Okay. Yeah. Oh, that's the last thing. Thank you. You just reminded me about the PAs, Alfredo. Thank you. That was the last thing I wanted to mention. And there's a note right in front of me, and I'm not even looking at it. Okay. Yeah. So the last thing I started doing, one of the things that changed also, I closed all of my PAs and all of my accounts with all those guys back when the whole thing with the legal case first happened. That was part of taking a break from it, and I just signed up for an eval last week, and it's just about to become a PA at Apex with their sale. And the idea was to use the cash approach that I was using trading real cash, but just trade it a little more aggressively for the next couple of months, because I think, in the case of the bigger ones, these guys are going to survive until at least through the end of the year. And that's an opportunity, again, to buy cheap drawdown and get to withdrawal pretty quickly. So yeah, I went ahead and did one of those. I'm not doing any copying, and I'm trading it really aggressively. Like I said, I'm on day 4, and I've already hit the target. I just need to trade 3 more days. So, but I'm using only those 4 setups, and again, the risk of failure is much lower. All you do is either blow up the eval, or if you've already funded it, it's $180 is your risk, and there's that other people's money, less pressure. A couple of people posted about that in the pit. That's a really strong point that you don't want to discount. That there's a freedom to trading other people's money that's impossible to duplicate in your cash account. So if there's a low risk way to trade other people's money profitably, you always want to take advantage of it. So yeah, thank you for reminding me of that. That's a perfect thing to end on. Okay, are there any other questions or comments? Burning desires going once. JVC, anything you would like to add or dispute?
Nope, nothing else to add. I will get this up in the risk management section of the library today.
Cool. And again, I try to keep this to an hour because I don't want to get into just tons of detail. But, if we need to have a, risk management update, execution tactics session in a week or 2, we can do that. Otherwise, tune into any of my live sessions, and I'll try to show as many examples of these 4 setups and how I'm using the new LR tools as opposed to the LRCs to game the entries and exits to those setups. Cool. All right. We'll call it a session then. Thanks, everybody. Don't forget, today I'm not doing a live one, but we have FOMC in an hour. So that could be interesting from a lot of perspectives. So be sure you're flat beforehand, and maybe you'll get a good intraday swing setup or some good momentum setups. Those are the 2 that are likely during the response to the FOMC. All right. Thank you, everybody. I'll see you later. See you tomorrow. Thanks, JVC.
Yep. Bye-bye.